Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tsui Properties Limited interim report. Tsui Properties Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are property-related activities, including property sales, rental, management, and trading. The company's portfolio comprises shopping malls, offices, industrial buildings, residential units, and car parks. In addition to property development and management, Tsui Properties Limited also engages in hotel operations, providing a unique blend of hospitality services to its clients. Its investment arm invests in securities, while its financing segment offers mortgage loan facilities to customers. The company's expertise extends to building construction and management, as well as project management activities. Furthermore, the company provides various ancillary services, including cleaning, administration, consultancy, and secretarial services. It also offers deposit placing, financing, and security services, making it a one-stop solution for its clients' needs. With a presence in Hong Kong, mainland China, Singapore, and Australia, Tsui Properties Limited has established itself as a prominent player in the real estate industry. Tsui Properties Limited market capitalization of $43 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Tsui Properties Limited holds a significant advantage in their industry. Tsui Properties Limited trades at a lower price-to-earnings ratio of 19 times and a higher price-to-book ratio of 0.42 times relative within the industry. This suggests a potential market detachment, as Tsui Properties Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 8% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various market trends. On the growth side, sales activities, launch of new projects, and recognition of sales from existing projects have contributed significantly to revenue increase. Strong office demand, talent schemes, residential leasing performance, and repositioning of One Central Place as premium residences have also driven growth. In addition, Hong Kong's tourism industry has shown resilience with a robust event calendar, recovering visitor arrivals and growing retail sales. The adoption of artificial intelligence, AI, by the company has also led to improved employee training and productivity. Furthermore, the sales of properties have seen a significant increase of 109% year-on-year. On the decline side, the soft retail environment at the beginning of 2025, market oversupply in the office sector, and intensified competition from online platforms have contributed to revenue decline. The growing prevalence of online shopping has put pressure on offline retailers, while the property rental revenue decreased by 23.7% year-on-year. Overall, the company's revenue growth is driven by a combination of factors including sales activities, new project launches, strong office demand, and tourism industry resilience. However, market trends such as soft retail environment, oversupply in the office sector, and online competition have led to revenue decline. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company is indeed producing positive operating cash flow. This is confirmed by two separate sources. Page 11 explicitly states positive operating cash flow. Yes, and further evidence can be found on page 30, where it is reported that the net cash generated from operating activities amounts to $149 million, a clear indication of a positive operating cash flow. The company's debt level has undergone significant changes in recent years. On one hand, long-term loans receivable have increased by a substantial 32% to HK $3,218 million, indicating an expansion of the company's financial obligations. Conversely, trade payables have only marginally increased from HK $71 million to H $95 million, suggesting that the company has managed its short-term liabilities effectively. However, it is worth noting that advances from non-controlling interests have seen a minor increase of H million dollars to HK $70 million. Despite these changes, interest expenses have not followed suit in a significant manner. In fact, interest paid decreased from HK $23 million in 2024 to HK $31 million in 2025, which may seem counterintuitive given the increased debt levels. Nevertheless, total finance costs did decrease from HK $54 million to HK $32 million, indicating some cost savings for the company. Overall, while there have been fluctuations in debt levels and interest expenses, the changes are not drastic enough to suggest a significant shift in the company's financial situation. Management statements about the company's outlook and strategy are centered around maintaining a strong position in the market. The office sector may face challenges, but Sino Land's portfolio remains well-suited to attract tenants seeking high-quality workspace. This is due in part to the company's focus on sustainability, which will continue to drive demand for its residential properties. The group emphasizes its commitment to corporate transparency, sustainability, and good governance, with a goal of creating long-term value for stakeholders and the communities it serves. Management also highlights its dedication to building a more sustainable future through green design, planning, and management. Financial prudence is another key aspect of the company's strategy, as management seeks to drive operational efficiency and productivity. Overall, Sino Land's outlook and strategy are focused on maintaining a strong market position while prioritizing sustainability and good governance. By upholding these values, the company aims to create long-term value for its stakeholders and contribute positively to the communities it serves. The company has made significant moves through acquisitions and divestitures in recent times. The acquisitions include the purchase of two key properties, New Kowloon Inland, lot number 6674, and Tuen Mun Town lot No. 569. These strategic purchases are expected to bring in substantial benefits to the company's operations. On the other hand, there have been no divestitures made by the company, indicating a focus on expansion rather than downsizing. This suggests that the company is committed to growing its assets and increasing its market presence. The company has a history of paying dividends to its shareholders. In recent years, the final dividend declared and paid by the company has been increasing. For instance, in 2024, the company paid out a total of $912 million in dividends, while in 2025, this amount rose to $940 million. In addition to paying cash dividends, the company also offers shareholders the option to receive shares in lieu of cash dividend payments. This scrip dividend scheme allows shareholders to choose between receiving cash or additional shares as part of their dividend payment. In both 2024 and 2025, a significant amount was issued in lieu of cash dividend, with $906 million and $934 million respectively. Overall, the company's commitment to paying dividends demonstrates its focus on returning value to shareholders, while also providing them with flexibility through the scrip dividend scheme. That concludes the financial summary for Tsui Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.